Welcome to Splendid Leading. Good morning to all. Today we have a discussion on basic accounts concept which is used for business and commerce students. Financial accounting, that is recording and reporting financial transactions. Accrual principles, the transactions are recorded when it happens. Break even point, no profit, no loss. Tool for cost management. Rules for accounting. Debit means expenses, credit means gains. Cost accounting. Recording of all costs involved in business. Marginal cost. It's also called incremental cost. It deals with cost in additional units. GAAP. Generally accepted accounting principles. Matching principles. That is, revenues and expenses are always matched. Materials managerial accounting, that is managing the transactions of business finance with the effective decision making. It is also called management accounting. Budgetary control, preparation coordination of budget to profitability. Fund flow statement, inflow and outflow of assets of the economy. Cash flow statement, tracking and managing the cash flow. Variable cost, changing output cost. Financial statement analysis, reviewing finance for better decisions. Disclosure, release of information when required for investors' decision. Retained earnings, the amount of profit after all payments. Activity ratio, financial metrics from balance sheet. Balance sheet prepared at the end, last step in final account creation. Common size statement or vertical analysis, the analysis and interpretation of financial statement. CVPA, cost volume profit analysis, changes in variable and fixed cost. Ratio analysis, company's liquidity operation and operational efficiency. Trend analysis, future stock price movements. Management accounting, pursuits of organizational goals and decision making. Quick ratio measures the capacity to pay current liability without selling inventory. Ascertainment of cost, calculating cost actually incurred. Variance analysis, assessing the price and quantity of materials, labor and overhead costs. Labor turnover, dividing the total number of leavers in a year by your average number of employees in a year. Idle time, the paid time that an employee or machine is unproductive. Cost of living index compared the prices of a range of goods and services on which consumers spend their money. Working capital is a financial metric which represents operating liquidity available to a business. Semi-variable cost, a cost composed of a mixture of both fixed and variable components. Conservatism is a principle that requires company accounts to be prepared with caution and high degree of verification. The dual aspect concept, all transaction has a dual effect, accurate movement of funds. The realization principle, revenue should be recognized once it is earned. The business entity concept, transactions separately recorded from owners and businesses. Cost, the amount of payment made to acquire any goods and services. An implicit or direct cost is any cost that has already occurred but not necessarily shown or reported as a separate expense. Explicit costs are normal business cost in a company's general ledger and directly affect its profitability. Opportunity cost, the value of the next highest valued alternative. Opportunity cost equal to return on most profitable investment choice. Economic cost are the monetary value of goods and services that producers and consumers purchase. Amortization refers to the expensing the acquisition cost minus the residual value of tangible assets. Accounts receivable means revenues earned but not yet collected. Owner's equity, sometimes referred to as net assets, is represented different depending on the type of business ownership. Financial accounting purposes, producing financial statements for decision making, for performance evaluation, for regulatory requirements. Activity based costing or ABC, is a technique of identifies activities in an organization and assigns the cost of each activity to all products and services. Whole life cost is the total cost of ownership over the life of an asset. Management accounting is a method of accounting that creates statements, reports, and documents that help management in making better decisions related to their business performance. Managerial accounting encompasses many facets of accounting, including product costing, budgeting, forecasting, and various financial analysis. Accounting postulates form the basis of the accounting standards that govern how transactions are treated and recorded. Zero based budgeting is a budgeting technique which all the expenses must justified for a new period or year starting from zero. Versus starting with the previous budget and adjusting it as needed. It is simply called the budgeting of without considering the past and starting the new principles with the fresh manner. Thank you.